I'm Michael Waldron, Director of Portfolio Management at Heritage Financial Services. Thank you for watching our presentation of the Real Deal Economy. Let's dig into the economic data dominating headlines today and the implications for an investment portfolio. We'll focus on individuals' perception of the economy compared to the reality of financial markets performance, AI and tech developments and their impact on growth versus value investing in fixed income during the late innings of a rate hiking cycle, and international investing amidst exceptional returns for the US. In my meetings with clients, I hear individuals' perceptions to be generally negative about the economy. Cutting across political lines and demographics, it seems everyone's annoyed by inflation and the current prices of goods and services that they consume. Regarding investments, I'd categorize most investors as worried. It's hard to find much positivity and optimism. But the first half of 2023 has been a remarkably good time to be an investor. US stocks are up 16.89%. That's an annualized pace of about 28%. International stocks are up 12.13%. That annualizes to 26%. Emerging markets are up 5.10%, annualized to about 10%. US investment grade bonds up 2.09% for half a year. That's 4.25% annualized. And high yield bonds up 5.41. That annualizes to 11%. Meanwhile, on the economic front, certainly compared to all the recession predictions, the measures have been quite positive. The unemployment rate remains historically low, with those willing and able to work mostly gainfully employed. Inflation has come down to a 4% annualized rate, now just above the steady state equilibrium range of 2 to 3%. And global growth is still hanging on, with no recession yet experienced. So why such a disconnect? I postulate that economic unpredictability is resulting in discomfort. A way to measure unpredictability is to view an economic release, such as CPI, as having two components: the forecasted value by widely followed and reputable institutions, and the forecast error. Giraudo, Ludvigsen, and Ng created a composite of economic forecast errors. The average forecast error is normalized to 0, and the index shows how unpredictably the economy is behaving. The economy went on a long stretch from the end of the financial crisis to the beginning of the COVID-19 pandemic of being easier than normal to forecast. Since the start of the pandemic, it's become far less certain. While the index is well off of the peak of 2020, when forecasts were off because of the onset of the economy's response to the pandemic, which no one predicted well in advance, economic uncertainty has remained elevated, currently at 1.27 standard deviations above normal, or approximately in the highest 10% of observations. High degrees of uncertainty are unsettling. It feels like the ship has no captain. Economic forecast misses autocorrelate highly, meaning that they have a long half-life, or it takes a while to stabilize. While the perception of a chaotic economic environment may be weighing on investors' psyches, the reality is that some of the data are coming in quite comforting. The second quarter of 2023 saw the Fed pause its rate hiking cycle. That has brought the federal funds rate up to a target rate of between 5 and 5.25%. A shift in monetary policy from tightening to neutral is a major event. Why did the Fed pause? In May, inflation posted a 4% annual rate of increase, the lowest rate of increase in 2 years. The impact of interest rate increases diffuses into the economy over many months. As the impact of higher interest rates seeps in, we may settle into inflation of 2 to 3%, somewhere in the normal range. Sometimes forecast errors might be high, but the economic releases are on track. For an investor assessing her portfolio, the conclusion is stocks and bonds have climbed a wall of worry in the first half of 2023. The economy has shown above normal uncertainty. What's happening with inflation, and will it actually come down to its target range? Will the Fed resume increasing interest rates, Or are we watching the switch to a new regime of easing later this year? Will the rate increases trigger a recession? Despite all this uncertainty, it's an important period to be invested, making up much of the lost ground in 2022 and producing an above average return across all major asset classes. Let's go a level deeper and talk about AI and tech and its impact on growth and value investing. A very early demo of ChatGPT was released in November of 2022. As the market absorbed the new artificial intelligence milestone, common opinion is that the technology sector took off. And the return difference between growth and value stocks would seem to support this, with a 23% return differential through the first half of 2023. In reality, I believe the story is more complicated than this simplistic view that the market missed AI and now growth companies are going to have a much brighter road ahead. Style investing, that is growth price stock returns against value price stock returns, naturally ebbs and flows. In 2022, the value style beat the growth style by more than the difference that we've seen this year. When you have discrete snapshots, such as a calendar year, it's easy to miss the big picture. Take a look at the last 18 months. Starting at the beginning of 2022, value stocks are down 4.5%, while growth stocks are down 10.5%, a cumulative value premium of 6%. Over time, we believe valuations matter. The empirical data support that through the noise, which can seem extreme, investing at reasonable prices in businesses that are producing real earnings from their operations outperforms investing in companies whose valuations can only be justified if significant growth is realized. Strategically, we became excited about fixed income in portfolios at the end of 2022. I still hear clients ask, why would you own bonds in my portfolio if you know the Fed is going to increase interest rates? Remember, the Federal Reserve doesn't increase interest rates. It increases the federal funds rate, which is an overnight, ultra short-term funding rate. The yield curve, market interest rates by maturity, already builds in short-term interest rate increases where the curve is positively sloped. So the question, insofar as it's relevant to a fixed income portfolio, is not, will the Brady-led Patriots of old beat the Sanchez-led Jets? It's, will the win be more than a market set line, say 17 points? We believe the return profile out to the 5-year point in fixed income looks attractive today. If we're not at the end of the rate hiking cycle, we're very close to it, in the late innings. Let's stress test a 5-year treasury held for 1 year starting at the end of June. If rates remain steady at that point in the yield curve, the total return will be approximately 4%. If all relevant rates along the yield curve decline by 1%, the total return will be over 8%. And if rates rise by 1%, the downside is less than 1/2 of 1%. That's a risk return profile that we're comfortable with. Reasonable upside that looks like an average year for stocks, reasonable downside that's approximately no return, and a base case in the mid-single digits. Add to that the good scenario likely plays out in a bad environment for stocks, and you have a valuable asset class to combine into a portfolio. As I mentioned earlier, US stocks posted a 16.89% return for the first 6 months of 2023, which exceeded international stocks at 12.13% and emerging market stocks at 5.10%. Warren Buffett has famously been dismissive of the need for international investments. Most of us live in the US and want the US to succeed. And for the past 14 years, the US has, indeed, been the best global equity market category. So why invest internationally? Over the past 50 years, we've seen periods of significant runs in relative performance. Most recently, the US stock market has been on a long run of outperformance compared to international markets, and the cumulative outperformance has been one of the largest mountain peaks. But one can look back to the mid through late 1980s to see the value of international stocks. During those years, when the US was fighting high inflation, by increasing interest rates, international stocks cumulatively outperformed the US by 300%. After the 1990s, from the dot-com crash to the financial crisis, international stocks were the only saving grace in a stock portfolio, giving a global investor a positive return when a US-only investor went a decade with only a small loss to show. How likely are we to see international stocks outperform US stocks? While it's been a long time since we've seen the benefit, the conditions are present for a stretch where international stocks could be a key asset class in a well-diversified portfolio. In the US, current P/E ratios are above their 20-year average. Meanwhile, we're at a point in time where the interest rates are near the top of their 20-year range, which should result in lower P/E multiples, all else equal. Therefore, US stocks are looking slightly expensive, and we've been gradually rebalancing and sweeping some of the gains out of that asset class into other investments, mainly fixed income. Meanwhile, non-US stocks are selling at a current P/E ratios below their 20-year average, and at a rate that supports a much better return with no reliance on growth. The no growth earnings yield is 7.87%. Add some level of growth opportunities to that, and it's not a stretch to forecast international returns on the cusp of double digits annualized in the years ahead. Thoughtful allocators build resilient portfolios for a range of possible outcomes. A non-US allocation in stocks is an important element for risk management, and over the long term, our expectation is that it will increase risk-adjusted returns. So what's the real deal? It's important to be a disciplined investor and stay strategically allocated during times of uncertainty. If you miss the returns in the first half of 2023, you're sorely behind. Growth and value investing styles are noisy. While in the short run, it's a guessing game, in the long run, valuations matter, and having a price discipline when investing is a positive contributor to return. The risk-return trade-offs in fixed income, all the way out to the 5-year point, are attractive. Bonds play an important and accretive role in a portfolio today. You should welcome an appropriate fixed income allocation unless you don't need money from your portfolio and you're solely interested in growth at the expense of stability. Non-US stocks seem like the unloved stepchild after a long period of US outperformance, but often that unloved stepchild shows his or her true worth in the end. The conditions for outperformance are present. It's a smart move to maintain a globally diversified stock allocation to build a resilient investment portfolio for the future. How should you be thinking about the economy as an investor? At Heritage, we remain positive on traditional stocks and bonds and have reduced our allocations to real assets and alternative investments after they played their role well in 2022. We continue to add to fixed income, both from an allocation standpoint, more dollars in fixed income, and from a risk or duration standpoint, more interest rate sensitivity as the risk return profiles become ever more attractive. And we are maintaining our value tilt in our equity allocation in the face of a growth storm. The value thesis is noisy in the short term, but we believe it's an important source of return in the intermediate to long term. Stay the course. Thank you for your time. I hope you'll tune in next quarter as we dig into the economic data and sort out what to ignore to get to the real deal.